Is the housing market about to flip, or are landlords about to face financial ruin?
Danielle DiMartino Booth and Nick Gerli dig deep into these questions, offering data-driven analysis you won't find anywhere else.
We've condensed their critical insights and a few other experts into easily digestible summaries, saving you hours of research.
First up, Danielle DiMartino Booth reveals whether a buyer's market is on the horizon. Then Nick Gerli uncovers what's going on with landlords. Just a quick reminder, this content is for educational purposes only and not investment advice.
Today, we're diving into insights from Danielle DiMartino Booth on the latest market trends and economic indicators.
Danielle is a well-known financial commentator, so it's worth checking out her perspective on where the economy is heading.
So what E28099's on the agenda?
We E28099LL look at her thoughts on the possibility of a buyer's market, changes to HUD and FHA policies, and recent retail sales data.
Danielle DiMartino Booth is discussing some key trends in today E28099's market.
Yes, and Danielle is focusing on the potential shift in the housing market, changes to HUD and FHA, and the latest retail sales data.
So a mix of factors influencing the market right now.
Absolutely. Danielle E28099's insights could be helpful for both buyers and sellers.
Danielle DiMartino Booth discusses the possibility of a coming buyer's market. What's driving this potential shift?
Well, Danielle points to rising interest rates and increasing housing inventory as key factors. This could shift negotiation power to buyers.
So, more houses on the market and higher mortgage rates mean buyers have more choices and less competition.
Exactly. And sellers might have to lower prices or offer concessions to attract buyers.
Is there any way to know if this prediction is playing out in real time?
Danielle suggests monitoring inventory levels and sales data in your local area.
Okay, so keep an eye on how many houses are for sale and how quickly they're selling. Got it. Danielle DiMartino Booth also touches on changes to HUD and FHA policies. What's new?
Danielle highlights some key updates aimed at assisting first-time homebuyers and those with lower incomes,
Such as
changes in lending criteria, down payment assistance programs, and updated loan limits could benefit certain buyers.
So, it's worth checking out the new guidelines if you're looking to buy a home.
Absolutely. Danielle suggests that understanding these changes can open doors for many potential homeowners.
Danielle also discusses the latest retail sales data. What are some of the key takeaways?
Danielle points out that a slowdown in retail sales could signal a cooling economy, while strong sales might indicate continued inflationary pressures.
So retail sales are a barometer for the overall economy.
In some ways, yes. Danielle suggests watching these figures to understand consumer behavior and economic health.
Any specific sectors to watch?
Danielle suggests paying attention to discretionary spending, as it's often the first area to be cut back during economic uncertainty.
What's Danielle DiMartino Booth's overall outlook on the market?
Danielle suggests that the coming months will be crucial in determining whether we see a significant shift in the housing market and broader economy.
So it could go either way.
Exactly. Danielle emphasizes the importance of staying informed and being prepared for potential shifts.
Any specific advice based on her analysis?
Danielle DiMartino Booth recommends that potential homebuyers carefully assess their financial situation and understand market dynamics before making any decisions.
Solid advice. Do your homework and be prepared. So, according to Danielle DiMartino Booth, what should we be watching closely?
Danielle emphasizes keeping an eye on retail sales and housing data to understand where the economy is heading.
Retail sales and housing, got it. Any particular data points?
Watch for changes in consumer spending habits and shifts in housing inventory. These will be key indicators.
Danielle also mentioned some changes to HUD and FHA. Should potential homebuyers be paying attention?
Absolutely. Danielle DiMartino Booth suggests understanding the new guidelines can provide opportunities for first-time buyers.
So do your homework on those HUD and FHA updates. Today, we're diving into an analysis by Nick Gerli, founder of Reventure Consulting, on the precarious state of Florida's rental market.
Nick's been tracking real estate trends for years, and he's raising some serious alarms about what's happening in the Sunshine State.
He sees some dark clouds on the horizon, pointing to potential defaults and a market collapse.
Yep, and it's not just doom and gloom. Nick has some data-driven insights on what to watch for. Let's get into it.
Nick Gerli's analysis suggests that Florida's rental market is on the verge of collapse, with landlords facing potential defaults.
That's a bold claim. What's driving this potential crisis?
Nick points to a combination of rising costs, the end of eviction moratoriums, and an oversupply of units.
So it's more than just one factor?
Exactly. Nick thinks these factors are creating a perfect storm for landlords.
Okay, so it sounds like we're in for a bumpy ride. Let's unpack those factors and see what Nick's really worried about.
Nick notes that landlords are getting squeezed. Their expenses are up, but rental prices aren't keeping pace.
That's right. Higher mortgage rates, insurance costs, it all adds up, but they can just jack up rents without losing tenants.
So they re-stuck in a tight spot.
Exactly. Nick explains this is putting huge pressure on their cash flow.
Nick points out that the end of the eviction moratorium means landlords can finally remove non-paying tenants.
Yep, but that also means more vacant properties, which puts downward pressure on rents.
It's a double-edged sword?
Precisely. Nick suggests we're seeing a backlog of evictions hitting the market.
Nick highlights that Florida's been building like crazy. There's a ton of new supply coming online.
And when you have too many apartments chasing too few renters, prices drop.
So it's a perfect storm.
Nick seems to think so. Rising costs, evictions, and oversupply done a recipe for trouble.
Nick predicts a wave of landlord defaults, particularly among those who over-leveraged during the boom.
That makes sense. If they can't cover their costs, they'll start handing back the keys.
So what's the trigger?
Nick suggests watching those rising interest rates. They could be the breaking point for many.
Nick is pretty blunt. He sees a potential collapse in Florida's rental market.
Wow, collapse is a strong word.
Yeah, but he backs it up with data. He thinks the combination of factors could lead to a significant downturn.
What does he think is a likely time frame?
Nick didn't give an exact time frame, but implied that the next year is critical.
So we're talking about falling rents, increased vacancies, and landlords going under.
Exactly. Nick thinks it could get ugly. Nick Gerli suggests keeping a close eye on Florida's rental market. It seems like the canary in the coal mine for broader real estate troubles.
Right? Monitor those default rates and rental prices. They could signal bigger problems ahead.
Nick also mentions tracking landlord default rates, especially in highly leveraged areas.
Basically, if landlords can't make their payments, it's a red flag for everyone else.
Today, we're diving into insights from Peter Grandich, a well-known financial commentator.
Peter has been analyzing market trends for years, and he's got some strong opinions on the future of gold.
He's not just throwing out predictions, he's basing it on macroeconomic factors and historical trends.
Exactly. He's connecting the dots between global events and your investment portfolio.
Peter Grandich argues that gold serves as a crucial hedge against economic uncertainty.
Absolutely. It's like having a financial safety net when everything else is shaky.
So gold is like the financial equivalent of a bomb shelter.
Precisely. In times of crisis, it provides a sense of security.
Grandich points out that central bank policies and increasing debt levels are key factors driving gold's appeal.
Yep, when central banks are printing money and governments are piling on debt, gold becomes more attractive.
So the more the central banks fiddle, the more gold glitters.
Exactly. It's a reflection of distrust in traditional financial systems.
Peter Grandich believes that ongoing geopolitical tensions are a significant driver for gold.
Right? In times of uncertainty, investors often flock to safe haven assets like gold.
So you're saying the more chaos, the more gold shines?
Pretty much. Gold acts as a hedge against geopolitical risks.
Grandich emphasizes that increasing debt levels could trigger a financial crisis, further boosting gold prices.
Yeah, it's like a ticking time bomb. When governments are drowning in debt, gold becomes an attractive alternative.
So, gold becomes the lifeboat when the debt Titanic starts sinking.
Spot on. People lose faith in traditional currencies, and gold steps in.
Peter Grandich predicts gold prices will substantially increase if central banks fail to control inflation.
Makes sense. If inflation runs rampant, gold's appeal as an inflation hedge grows stronger.
So if inflation goes wild, gold goes wild too.
Exactly. It's a direct correlation.
Grandich also suggests that a potential reset of the global monetary system could dramatically boost gold's value.
Yeah, a major shift in how money works could send gold soaring.
So we're talking about a financial system reboot with gold taking center stage.
That's the potential scenario. If confidence in fiat currencies erodes, gold becomes the go-to asset.
Peter Grandich stresses that gold should be viewed as insurance rather than a get-rich-quick scheme.
Right. It is about protecting your assets from unforeseen financial storms.
Grandich suggests diversifying your portfolio with physical gold and silver.
Makes sense. It's a hedge against inflation and economic uncertainty. It's like having a backup plan for your backup plan.
Peter also recommends keeping an eye on central bank policies.
Absolutely. Any major shifts in monetary policy could significantly impact gold's price.
Today, we were diving into a crucial analysis from Jeff Snider at Eurodollar University. He's been digging deep into the recent warnings from the Australian Central Bank.
Jeff's insights could give us a heads up on potential market shifts and economic impacts around the globe. Get ready, because what he's covered is pretty intense.
So why is this analysis so important right now?
Well, Jeff believes it flags some serious undercurrents in global financial systems that most people aren't even aware of. We were talking about major stuff.
Jeff Snider believes the Australian Central Bank's warning isn't just a local issue, but signals deeper problems in the global financial system. Let's unpack this.
Right? Jeff thinks they were hinting at potential liquidity issues and economic challenges that could affect everyone. It's like a global financial weather forecast.
So what's Jeff's main concern?
Jeff Snider is really focused on how these hidden risks could impact markets and the economy worldwide. It's not just about interest rates, it's about the plumbing of the financial system.
Okay, so it's more than just surface level stuff.
Exactly. Jeff's digging into the underlying mechanics that keep everything running.
So, Jeff Snider points out that the Australian Central Bank's warning isn't just about local issues. What's the bigger picture here?
Jeff highlights that they were signaling potential global liquidity problems. That's like a doctor saying you might have deeper health issues beyond that cough.
Liquidity problems, huh? That doesn't sound good.
Understatement of the year.
What kind of liquidity problems are we talking about?
Jeff elaborates that it's about the availability of money and credit in the financial system. When liquidity dries up, things get tight, and markets can become unstable.
So it's like the financial system is running out of gas.
Exactly. And when that happens, everyone feels the pinch.
Jeff Snider emphasizes how interconnected the global financial system is. How does this tie into the Australian warning?
Jeff explains that what happens in Australia doesn't stay in Australia. It can ripple through global markets because everything is so linked.
So it's like a financial domino effect.
Precisely. One small stumble can trigger a whole series of crashes.
Jeff discusses the US dollar's role in all of this. What's his take?
Jeff Snider points out that the US dollar is still the world's reserve currency, so any dollar shortage can create huge problems globally. It's like the world's financial lubricant is running low.
And we all know what happens when you don't change your oil.
Yep, things grind to a halt.
Based on Jeff Snider's analysis, what kind of market impacts could we see?
Jeff warns that if these liquidity issues persist, we could see increased market volatility, credit crunches, and even potential economic slowdowns globally.
Sounds like a recipe for financial chaos.
Pretty much. Hold on to your hats.
Jeff Snider also touches on how this might affect everyday investors. Any insights there?
Jeff emphasizes that it's crucial for investors to stay informed and cautious. Diversification and understanding risk are more important than ever.
So, basically, don't put all your eggs in one shaky basket.
Exactly. Smart investing is key when storm clouds are gathering.
So, what's the big takeaway here?
Jeff Snider paints a pretty clear picture. Central banks are grappling with liquidity issues and economic headwinds that could really shake things up.
Sounds like we're in for a bumpy ride.
Buckle up, Buttercup.
Any last words of wisdom from Jeff Snider for our viewers?
Pay attention to how these liquidity dynamics play out. They are a key indicator of where the global economy is headed.
So basically, keep an eye on the financial weather forecast.
Exactly. Stay informed, stay prepared, and maybe stock up on some popcorn for the show.
Today, we're diving into Ken McElroy's analysis of the recent moves in interest rates and what they mean for investors.
Ken brings a wealth of experience in real estate and finance to the table. He's not afraid to call it like he sees it.
And he's been particularly vocal about how these rate hikes are setting the stage for something big. A lot of uncertainty out there.
Exactly. Ken provides a reality check on what's really happening behind the headlines and how to protect your wealth.
Ken McElroy believes that recent aggressive moves in interest rates signal a fundamental shift in the economic landscape.
He emphasizes the importance of understanding how these rate hikes impact everything from stock valuations to real estate investments.
So, basically, everything we thought we knew about the market has changed.
Yep, the old playbook is out the window.
Ken argues that investors need to reassess their strategies to navigate the new economic reality.
He's urging everyone to take a hard look at their portfolios and make sure they're positioned to weather the storm.
So it's time to get strategic.
Exactly, hope is not a strategy.
Ken explains that the Federal Reserve's primary goal is to curb inflation, even if it means risking a recession.
Exactly. They're trying to walk a tightrope. Too aggressive and they crash the economy, too lenient and inflation runs wild.
So basically, they're damned if they do, damned if they don't.
Pretty much. Kind of like choosing between a root canal and a colonoscopy. Neither is fun, but one has worse long-term consequences.
Ken points out that rising interest rates impact the value of assets across the board, from stocks to real estate.
Yep, higher rates make borrowing more expensive, which cools down demand and puts downward pressure on asset prices.
So the party's over for cheap money?
Exactly, and now we have to deal with the hangover.
Ken suggests that if the Fed continues its aggressive rate hikes, we could see a significant correction in the stock market and real estate.
Yep, history shows that markets don't like uncertainty, and aggressive rate hikes often trigger a risk-off sentiment.
So tighten your seatbelts?
Absolutely, it's going to be a bumpy ride.
Ken warns that high interest rates could lead to a slowdown in economic growth, potentially triggering a recession.
Exactly. Businesses and consumers will pull back on spending, and that can create a ripple effect throughout the economy.
So batten down the hatches?
Yep, it's time to prepare for a potential storm.
So what's the takeaway here?
Ken McElroy emphasizes that understanding the direction of interest rates is crucial, especially with the recent massive move. Keep an eye on those Federal Reserve meetings.
Right. So basically, listen to what the Fed officials are saying, or pay the price.
Yep, the Fed giveth and the Fed taketh away, usually in a way that's bad for your portfolio.
And what about those asset valuations that Ken was talking about?
Ken stressed that it's crucial to evaluate if current asset valuations are sustainable given rising interest rates. Are you paying too much for your investment?
So basically, don't marry your investments. Be ready to dump them if the numbers don't add up?
Exactly. Your investments are like Tinder dates. If they ghost you, move on.
Wow, didn't we cover some ground with our experts today?
Absolutely. Ken McElroy discussed real estate opportunities, while Jeff Snider emphasized the importance of liquidity.
And then there's Peter Grandich talking about how precious metals can be a hedge against inflation.
Right. But then Nick Gerli pushed back on the housing market outlook with potential risks from government policies.
Exactly. And Danielle DiMartino Booth rounded it all up with her insights on economic indicators.
It's amazing how they agree on the need for thorough market understanding, but differ on specific strategies.
For instance, Ken believes in growth, while Nick is more cautious about policy impacts. It's so enlightening.
And seeing varying perspectives just enriches our understanding.
If you gained valuable insights today, make sure to like this video and subscribe for more expert analyses.
We're dedicated to bringing you the best financial insights, so your support keeps us going.
Don't miss out on what's next. Stay tuned for more discussions that can help shape your financial journey.
Thanks for watching, and we hope to see you next time for more engaging content.